Hello and welcome to the third video in this series of the video tutorials on some of the commonly used MT4 indicators. This video today will be covering the topic of RSI, that is the Relative Strength Index indicator. So what is the RSI? RSI, as mentioned, stands for the Relative Strength Index. It is a momentum indicator like the MACD, which we covered in the previous video. This indicator is used to compare the momentum of the rise in the price value to the momentum of the drop in the price value. It is a technical tool that helps identify the market conditions for a given financial instrument as overbought or oversold. Let's now discuss how the RSI indicator works. RSI uses the past data over a fixed period of time, mostly a 14-day period, to find the average gain in the price of a financial instrument relative to the average loss over the same period. The average gain or loss is computed daily relative to a reference price level, such as the close price or the open price. The result is then plotted between two fixed levels that are set at 0 and 100. These are known as the fixed minimum and fixed maximum respectively. There are another two levels fixed between these fixed minimum at 0 and fixed maximum at 100. These two levels between 0 and 100 are used for identifying the overbought and oversold areas. The two levels between 0 and 100 are generally set at 30 and 70. Below 30 is considered as the oversold territory or the oversold area, and above 70 is considered as an overbought territory or an overbought area. A move of the RSI below 30 is considered as a buy signal, since the price of the financial instrument is at the levels where it is considered to have been oversold and there is scope for potential buying. Similarly, a move above 70 is considered as a sell signal, as at those price levels the financial instrument is considered to have been overbought and it is considered to have a potential to being sold. Let's have a look at this on the trading platform to understand this better. We consider applying the RSI indicator onto the dollar-yen chart, as we can see over here. You can select the indicator from the list of indicators in the navigator window. As you can see, the period for the RSI is 14, which is the most commonly used period. You can change this, however, based on your preferences. We shall keep this as 14. What this means is that this indicator will be using the past data of the past 14 periods in the calculations. The levels set between the 0 and 100 levels is 30 and 70. Having selected these parameters, we click OK. As you can see, 0 is the fixed minimum and 100 is the fixed maximum. Between 0 and 100, we have 30 and 70 as the fixed levels. The blue line is the value of the RSI as computed. Above 70 is considered as the overbought area, and below 30 is considered as the oversold area. These levels at 30 and 70 act as the underlying support and overhead resistance respectively. So mostly traders tend to buy as the RSI reaches close to 30 and sell the financial instrument as the RSI moves closer to the 70 level. Let's now have a look at how is the value of the RSI, which is plotted onto this chart, calculated. The formula used to calculate the value of RSI is as given. RSI is equal to 100 over 1 plus RS, where RS is the ratio of the average gain to the average loss. Here, average gain is the sum of the gain of the price of the financial instrument relative to the reference price, which is either the close or open price, over a given period of time, divided by the total time period taken into consideration. And similarly, the average loss is the sum of loss over the chosen time period divided by the total time period taken into consideration. Let's consider an example to understand this better. We consider the calculation of a 14-period RSI using the close price of the financial instrument as a reference price. The fixed minimum is set at 0, fixed maximum is set at 100, the overbought level is at 70, and the oversold level is at 30. We consider the data for the close price of the euro-dollar as given in the table. The gain is the difference between the close price for day 2 and the close price of the previous day, that is day 1. We calculate the difference between the close price of each day from the previous day's close price to determine whether there has been a gain or a loss. If the previous day's close is higher than today's close, it is considered to be a loss, while if the previous day's close price is lower than today's close price, it is considered as a gain. To calculate the average gain, we consider the gain over the period of first 14 days and divide that by 14. Similarly, average loss is calculated by taking the sum of losses over the first 14 days and dividing by 14. RS is then taken as the absolute value of the ratio of the average gain to the average loss for the first 14 days. And this RS is then used for computing the RSI using the formula that we discussed. On the 15th day, the calculation will now be from day 2 until day 15. We will disregard the reading for day 1, and this way the price data will keep on moving as the new data becomes available. So here, this average gain is the average gain over the period from day 2 until day 15. And similarly, we calculate the average loss over the same period from day 2 to day 15. We calculate the absolute value of the ratio of the average gain to average loss over this period from day 2 to day 15, and then compute the RSI. Please note that by considering days 2 to 15, the total time period still remains the same, which is 14 days. Therefore, the denominator in the calculation of average gain or average loss remains constant as 14. Here we explain how the average gain was computed. These are the readings of the average gain from day 1 until day 14. The sum of those average gains, the 6 readings, divided by 14 gives us the average gain over the first 14 days period. Similarly, we calculate the average loss as the sum of the loss between the first 14-day period divided by 14. RS is the absolute value of average gain over average loss, which comes out to be 0.92665. We put this value in the formula for RSI, which is 100 minus 100 over 1 plus RS, and it comes out to be 48.10, which is what we saw in the table, 48.10 for the first 14 days. Since the RSI is 48.10 and is followed later on by higher values of 57.34 and 55.93, so we interpret that the RSI is midway between 30 and 70 and is moving towards the overbought level at 70. Next, we move on to understanding the divergence of the RSI and how it can be used as a trade signal. The divergence of the price of the financial instrument to which the RSI has been applied from the value of the RSI can be used as a trade signal itself. There are two types of divergence of the RSI. These are the bullish divergence and the bearish divergence. Let's have a look at each one of them. Starting with the bullish diversion, when the underlying financial instrument to which the RSI has been applied makes a lower low and correspondingly the RSI at the same point makes a higher low, it is considered as a signal of a strengthening price movement and the trend reversal towards buying. Alternatively, if the price of the underlying financial instrument to which the RSI has been applied makes a higher high while at the same time the RSI corresponding to it makes a lower high, it is considered as a signal of weakening price momentum and a trend reversal from buying towards selling. Let's have a look at this at the platform. We consider the case of euro-dollar. As you can see, the pair is seen to be making lower lows. However, the RSI correspondingly is making higher lows. This is considered to be a bullish divergence, which is supported by the subsequent rise in the prices. Similarly, as we can see on the weekly chart, the pair is seen to be making higher highs. However, correspondingly, the RSI is making lower highs. This is considered as a bearish divergence, which is followed by a subsequent fall in the price value of the financial instrument being traded. This is all we will be covering on this topic about RSI and how we can use this as a technical trade signal to help with our trading activity. Hope this information was helpful. Thank you for taking the time to watch this video.